Will the 2022-2023 housing crash be worse than the crash we had in 2008? Well, inquiring minds want to know. We'll talk about that in a second here. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Burns and Crashes, etc., etc. We all know what's going on. Hey, today is September the 1st. Hope you're doing well. New month. Randy Patrick here, putting the realism back in real estate. We're going to get into this in a second here, but you know that this video is brought to you by who? Our friends at Foreclosure.com. So if you want to check out what's going on in your neighborhood, your neck of the woods, I suggest you go to gethousingdata.com. That's gethousingdata.com. Why? Because you can find out about tax deeds and pre-foreclosures and foreclosure auctions, etc. You can dial into your zip code, your county, your city. It's going to show you what's going on in your world so you can really verify what I talk about every day here on this channel. So check it out, gethousingdata.com. So this article came out the other day and I thought it was really good. So what we're seeing now is we've gone past the point of earlier in the year that everything's going to be okay. Now, high interest rates, the market's changing. We're seeing the big changes right now. It's going to happen more as the fall goes on. Bubbles bursting. We were talking crash. We're actually talking metrics as to how much home price values are going to drop. Okay, now we're seeing comparatives. So will the 2008 crash rival what's going to happen now, or will this crash be even worse? So, everyone's got their opinion. Let's go check it out right now. This article's cool. It's fuzzy. You can't see this picture. I get it. But really, we're just looking at colors here. So this is a map of home price growth at the bubble's peak in 2005. Obviously, the purple, the darker colors show the concentration of high home price appreciation and high growth. Let's go to this one, which is 2021. Well, not as much purple, but not as much yellow. We see a lot more orange. So basically, what does this tell us? When we take a look at the peak in 2005, we saw there was a lot of home price concentration growth in the Sunbelt states, Arizona, Nevada, California, and Florida, which all saw annual growth of over 20%. National home price growth was about 11% in 2005. Fast forward to today, 2021, 2022, where they're looking at this, is that the national home price growth is higher at the peak than it was at the last peak, around 14%, and the appreciation is much broader based. So we're seeing less of the purple, but we're seeing more of the orange. So there's more growth, more home price appreciation, and many more states. So again, 26 states back in the last housing crisis, or prior to the last housing crisis, had home price appreciation over 10%. We're looking at 38 states now. So there is a difference, okay? We're 26 to 38. We're talking 12 more, another third more states are sort of up there. You can see on the national home price growth chart there that there is a difference. Well, but again, how can we look at this? Will the 2008 crash, is it going to be worse than what we're going to have right now? Clearly, that's debatable. So this article takes a look at some key indicators, which are supply of newly constructed homes, mortgage spread or mortgage rates, and the growth rate of real money, basically liquidity. So ultimately, we're going to talk about the new home sales and inventory. Right now, the most recent information we got from Bureau of Labor and Statistics was 10.9, or National Home Builders was 10.9 months worth of inventory. So basically, it will take almost 11 months to clear out that inventory at today's sales pace. All right. Well, you know what? That's the more indicator or the higher number of new home sales that aren't, or I guess you could say inventory that's sitting there doing nothing. The higher month supply today means lower prices for the future. So that's what we have to look forward to. So this is a good indicator, basically, what's going to happen in the future. Also, inventory of new home compared to existing homes. We're more concerned about the new home inventory. Why? Because economic activity, there's more economic activity and money associated with, in jobs and purchasing whatever associated with new home construction as opposed to the resale of existing homes. I often mention this in my videos that, when you take a look at the GDP, the overall GDP, and take a look at the components that make up the GDP, the real estate sector makes up a significant amount. It's almost 25% of their overall GDP. So you can see how this is, interesting and or complex and can impact the overall market because you've got land sales, construction, materials, you name it, it's in there for new home construction. So that's why it's looked at very closely with respect to the overall contribution to our economy. Now, going back to the month's supply, so back just before the last housing crisis in 2005, in 2008, the month's supply figure exploded to 12.2 months, which was the all-time high. Well, guess what? We're at 10.9. So we are literally one in a little bit of months away from the all-time high. So it's saying that it's not quite as bad, although it could get there. But we're basically a month's supply difference. So yeah, we're kind of at a tipping point right now. That certainly is indicated what's going to happen in the future. Now, don't forget that the sales pace the sales volume is completely collapsing today, and there's no signs of a slowdown in the pace of the decline. So the decline is actually increasing. The volume of new home sales is down 51% since August 2020. And in 2008 into 2009, new home sales fell by 70%. So again, we're not quite as bad, but we haven't hit the bottom yet. So there's still more room to improve sales decline in the new home sector. So it could still further push down the crash. Interesting to see where things are at. All right. Mortgage rates. Well, this is the next component. Well, in terms of mortgage rates, we have a problem today that is actually worse in 2008. So the new home sales is not quite as bad, and inventory is not quite as bad as 2008, 5, and 8 time frame, but it's almost there. Here we can tell you that the mortgage rates, they are worse. Mortgage rates jumped 1.3% on a year-over-year basis. So in 2006, when the housing bubble started to pop, mortgage rates were 6.8% compared to 5.5% a year earlier. The spike in mortgage rates kills home prices because people just can't afford rising home prices and rising mortgage rates. So when you have the double whammy of home price appreciation and home pricing points going up and mortgage rates, what happens? Well, people go, I can't afford it, I can't buy it. So the pace of increase in mortgage rates is actually double the pace of the 2006 period that caused the housing bubble to pop. So that's an ominous sign that will cause buyer demand to stop dead in its tracks, something that we're already witnessing with new home sales crashing 51%. So the increase in mortgage rates is actually hurting this market more and worse than it was back in the last housing crash. Okay, so definitely something to think about. And what comment I'm going to make here is that I think we're seeing things play out a little faster. Like going from where we were in March to where we are today, we've seen a significant change in a lot of things in the housing market, which I think back last housing crisis and having that all play out did take a bit longer to manifest, or we just weren't really aware of it. All right. And by the way, guys, you can read for yourself there. If you love my channel, like the stuff I produce, please subscribe. I'd really appreciate that. Thank you very much. Okay, the next metric to consider is the rate of liquidity growth or money growth. Okay, in the lead up to the peak of the housing bubble in 2006, liquidity growth was not excessive. Basically, the bubble of 2006 and the crash in 2008 was more about a debt crisis and cheap credit. We all know about that. We all remember the mortgage meltdown and the subprime loan crisis and sort of people equity stripping their house with refinancing and cash out refis, et cetera, right? But money growth in 2020 and 2021 was more than 6 times as high as it was in the mid 2000s, which is why the housing bubble this time is more broad based rather than concentrated in select cities like it wasn't back prior to the last housing crisis. Today's bubble is more about record liquidity growth that was channeled into financial assets. This is an important concept, okay, because it's being channeled into financial assets. So when the big institutions started to access the single-family home market, housing became just another financial asset that was easy recipient of this excess liquidity that historically stayed in the stock market sector. So yes, we all know that towards the end of this previous housing crisis, hedge funds and a lot of money came in and said, you know what, we're going to start buying these properties. Now, homes are a commodity. They're single-family homes, a great asset. Let's see how we can monetize this and cash flow and whatever. So basically, that's a major difference to the 2008 bubble. The banks helped to facilitate a housing bubble by granting loans to households, but most of the housing activity was in the household sector itself. You see, so we have a lot of what's going on. I mean, I look at Zillow. Zillow, which is kind of imploded this past year, a year ago, with respect to their home buying business. They were their own worst enemy, right? The Zillow's estimates, they're buying and selling, they're believing their own bullshit. Basically, that's what happens in this marketplace. So today we have financial innovation in which big institutions and private equity funds that can easily access the Fed's new liquidity have moved into single-family homes. We don't know what a housing downturn will look like now that bigger players involved. Again, speculators versus homeowners. So one of the things that we talk about bubble theory and bubble concepts, and the naysayers to housing bubble or housing crash typically goes down this one pathway, this one point, and that point is you have to have speculation. So when retail buyers buy, that's not considered speculation. Well, when investors buy, it's considered speculation. So we have a lot more investors in the marketplace. That's obvious. We have a lot more larger institutional investors buying hundreds of thousands of units out there. That's speculation, okay, for sure. But don't forget what happened the past few years. When you had low inventory, you had what? Competition and bidding wars for homes. And you have, I mean, we can all look at the stories. We've all heard them. When you have buyers who are bidding 50, 100K above list price in a competitive world, tell me that's not speculation. All right. So for me, we've got speculations here right now. Basically, money growth never contracted or slowed below 0%. Money growth is falling sharply as the Federal Reserve pulls liquidity out of the system to correct an ongoing inflation problem. So just as easily as home prices went up because of liquidity, we may see the reverse. Good point here. Again, the Fed has been very obvious in stating what it's going to do. So if you've been living under a rock, you probably don't know that the Fed said we need to reset the housing market. So housing is in their crosshairs. The Fed says they want to get a hold of this inflation and bring it back down to the reasonable 2% per year. And guess what? The housing market is suffering for that. It will suffer more for that. Obviously, the other issues that we're facing are shortages, whereas food prices, other inflationary items, you know what I mean, like that's going on right now, gasoline, all the things we've talked about for the past few months, they all contribute. We didn't really have that last housing crisis. Again, it was more about debtor and easy access to credit and greed, but now we're seeing a government participating in the changing of this market for what they believe will be a better place once we hit a landing here. So the inventory issue is not quite as bad as 2008, which is a good thing, but the spike in mortgage rates is way worse, and the contraction in liquidity growth is more intense. So we're getting it from all sides, but it really is more on the financial side. The debt bubble was worse in 2008 because the debt was concentrated in the banking sector and household sector in the form of mortgages. Together, the household and financial sector had almost 220% of debt to GDP compared to 150% today. So the 2008 crisis started as a housing problem, but it morphed into a banking crisis, right? So it was a housing crash crisis that led to what? The Great Recession, right? Well, a little different this time. Today we have a much broader bubble than we did back then. The month supply in new homes is surging towards 2008 levels. Mortgage rates are spiking way faster, so the affordability crisis is worse, particularly when you add on food inflation, rent inflation, and gas inflation. Also, the rate of liquidity contraction is more intense to basically correct the Fed's mistakes of misreading the market back past couple of years. So the housing crash certainly has the potential to be worse than 2008 if we're talking about the housing market itself. So that's what I'm talking about. I'm not talking about other aspects of the economy. I'm saying the housing market itself is in a precarious situation here. There's much less of a chance that this housing downturn morphs into a global banking crisis. The non-financial shadow banking sector, that's a story for another day. So, if we also look around here too, there's other locations across the world that have a lot of stuff tied up in their housing sector and actually have worse housing bubbles than we do, believe it or not. And that stuff will be manifesting as we go on. But interesting that it has the potential. So, like every analyst or economist or whatever, nobody likes to make the big call, all right, here. So the housing crash has the potential to be worse than 2008. So at least we're getting dialogue. We're getting people saying, it's not going to be the same but different, if you sort of get what I'm saying here, right? Same situation, different factors, nuances pushing us over the edge or impacting what's going to happen. But it clearly could be way worse than what we experience. And the reason I say that is just, again, Core Logic came out yesterday. So take a look at what's going on. Obviously, we see the most recent year-over-year home price appreciation, still in that exponential growth. And this is the cool part here, too. So basically, when you take a look at where we are from the 2006 previous housing bubble peak, which was July 2006, to where we are today, this most recent month, the recent case logic would probably be, we're in September, probably be, we're talking probably June or May. I forget the month here, but we're 66.9% greater than the 2006 peak. So we're basically 67% greater than the 2006 peak. So that's a bubble. That's the issues. That just goes to show that our home price appreciation is wildly out of control. And ultimately, take a look at the current from the trough. So if you bought in the so those low 2000, 10, 11, 12 timeframes, you've more than doubled your money on your purchase. So good for you. So people did, experience some fun. But again, let's go back to all this financial talk here, right? What about the foreclosures? I always come back to this point. This resonates with me. All this financial talk about what's going on here, but we don't even talk about the foreclosure market. So here's what we have: increased housing inventory, obvious. We have price reductions. We're seeing them every day. We have contract cancellations on for reasons, maybe valid reasons, going, well, I can't afford the new mortgage rates now, so my financing doesn't work, so I have to bail on the contract. And people are going, I'm not buying this anymore because I'd rather lose my deposit than get stuck with the lemon here. So we're seeing that. Clearly higher interest rates and mortgage rates. We had a little bit of a reprieve a little while ago, a couple weeks ago, coming back up right now. Record low buyer sentiment. So home buyer sentiment is at the record lows. And once again, we always see things like, articles and reports on how home buying is the most stressful thing anybody will do in their adult life. Home price appreciation is slowing. I'm not talking Case-Shiller today, but you can check that out for yourself. But what we're seeing with Case-Shiller, as we have seen the past couple of months, is the pace at which home price appreciation is rising is slowing down. So home price appreciation is decelerating. All right, and that will start to play out as time goes on. Remember, Case-Shiller is a couple months lagging. And all this is going on. So if we're having all the economists and the analysts talk about housing crash, can it rival 2008? It'll be worse. Who knows? But all this is even before we talk foreclosures. So all this is going on doesn't have any impact of much cheaper priced and additional inventory coming to the marketplace or being available to home buyers, whether you're investors or primary home buyers, etc. The foreclosure tsunami, I just did 3 videos of it. The past 3 videos is just starting. The first wave, the legacy, the older stuff, the pre 2019 COVID stuff is moving through now. We're going to have 3 to 5 years of this playing out here. That's why I'm saying the foreclosures are not even factored into where the housing crisis is going to go. So from my perspective, all right, you take it what it's worth. I think the 2020, 23, and again, we have to, caveat, when it's going to start. It could be 2023, 2024, but you know what I'm saying? The next housing crash, okay, will be worse because if economists are saying we have all this potential now and not including the foreclosure stuff I just mentioned, then we're going to have some problems on our hand. The Fed wants to reset the housing market. They've been clear about that. They've actually said it outright. We need to reset the housing market to bring price points down so more people can buy and first-time home buyers can have the American dream. They've clear out said that. They want to reduce inflation. So how are they doing that? By raising interest rates, which in turn reflects on rising mortgage rates, which makes affordability an issue. And if sellers want to sell to accommodate the difference with these interest rates, reducing buying power, home sellers have to reduce price. Simple as that. Starts it all. And again, I don't think there are going to be bailouts here. So, what happened back in the last housing crisis? The Fed bailed the market out and tried to fix it. Well, they're not trying to fix it now. They're actually causing the problem, okay? They're saying we're causing the problem. We're resetting the market. We're making sure that the market corrects. So I don't think we're going to see bailouts happening on banks and lenders, though some small ones might get hurt. We'll have to see how it all plays out, but I do think it's very interesting. Hey, guess what? You want to talk about foreclosures? Okay, this is Maricopa County in Arizona. What's in Maricopa County? Phoenix, okay? Take a look. I just pulled out a few minutes ago for this video. 1,829 pre-foreclosures sitting there in the greater Phoenix area. So what does that mean? It means that the stuff's actually happening. It means in Phoenix being one of the #1 appreciating states, or Arizona state and markets, Phoenix metros across the country for the past number of years. Tampa has overtaken as #1 position in the past few months, but Phoenix being the leader for the 30 some odd consecutive months has 1,829 pre-foreclosures. Funny how that actually works, you see. So realize that, you see, in these markets of high appreciation, stuff like this will play out and will make a difference. So I'm showing that to tell people, to show you that there is hope for cheaper properties, that if this is what's happening now and it's going virtually unnoticed under the radar, just think what's going to happen in the next 1 or 2 years. All right, so please keep that in mind, guys. All right, again, looking for more agents in Florida to join my firm. I'm not looking to for people to work with, in different locations, sticking your own brokerage. You need to be in my firm. That's kind of the deal that I'm looking at, because you'll learn some of the stuff. We got built-in investor buyers, got a lot of cool stuff going on. Things I can't even talk to you guys about yet that I'm waiting to announce. It'll be very exciting, all right? Join my firm. I do want to open up other metros across the country, so check it out. I'm looking for investor buyers, looking for private lender partners, syndication equity fund. We want to work with people who want to do stuff like that. We're doing tokenization of real estate, doing stuff, NFT, real estate as NFTs and crypto and things like that. So some really cool things in the future. What I am looking for locally here in Tampa is a BPO agent, a broker price opinion person who does them on a going basis, who wants to join my firm. Some cool things. Also looking, I can't find the number. A gentleman called me a couple of weeks ago about doing securitization of properties in Orlando. His name was Leroy. Give me a call, dude. I couldn't find your number, so give me a call. All right. Look at that. You get your own shout out here. All right. Anyway, clearly short sale program's gone. New foreclosure thing going now. I got a call for all the people involved tonight. If you want to get in the program that I got going on, hop on the call. Just email me and we'll talk about that. All right. A lot of stuff happening these days. Send me your information. I'll get back to you. And that's the scoop for today. So once again, thank you for the views. Thank you for the likes and comments. Please share the video with your family and friends. Reach out to me for more information. Subscribe if you're not a subscriber. And guess what, guys? This is really happening now in the marketplace. So let's get it to the finish line.